Well, conflict overseas has been having a direct impact on investments and the U.S. stock market.
We're joined now by Tony Ogorek, president and founder of Ogorek Wealth Management, about what this means for your investments. Tony, thank you so much for joining us.
Hey, Kelsey and Jeff, how are you today?
Hi, we're good. All right, let's talk about where the stock market stands right now. What happened today?
This was sort of a relief rally. The market was up about 2.5%. Foreign markets were up anywhere from 3 to 4%. Japan and South Korea were up significantly more. Basically, there's an inverse relationship between the price of oil and the stock market at this point. As the price of oil goes down, which it dropped about 15% today, the stock market moves up, and that's essentially what happened.
And Tony, do you have any tips for long-term investors and those who may be getting closer to retirement age or already there on what they should do with their money?
Yeah, Jeff, I think a couple of tips make sense for people. First, it's time in the market, not timing the market. I think too many people they see these things and they try to time the market. Maybe I should get out and then I can get back in. You can't do that. It just doesn't work. You're going to be poor for that. And the second point, I think, is that there isn't a connection between the stock market and the economy. There isn't a connection between the stock market and politics. Oftentimes we hear people being very frightened about what they see, and they don't understand why the market's doing what it's doing. Fact of the matter is the market responds to pretty much a couple of things. One is lower interest rates, as well as earnings forecasts. And as long as earnings forecasts look good and rates are not going up, the market is going to be pretty sanguine about the future.
If there's volatility going on, do you suggest people invest more into government bonds or other bonds per se? Is that some suggestion that you're making?
Well, this Friday we're supposed to get CPI figures, the Consumer Price Index. And, when you look at energy prices being up, you look at airline tickets being up, general inflation is moving up. Typically, bonds are not going to react very well to that. I think what makes a lot of sense for people at times like this is they really have to look at their asset allocation, which is their mix of stocks, bonds, and cash in their portfolios, and just make sure that they're not taking more risk than they should. Specifically, because the last 3 years, the market's been up double-digit rates. And if people haven't rebalanced their portfolios, their stock position may have grown, for example, from 50% up to 70% of their portfolio. Obviously, you've got this kind of volatility. It can, raise a concern for them. So I would take a look at that, look at your models, and make sure that you're accepting the level of risk that you're comfortable with.
And Tony, as we get into the summer months here, when more people traditionally spend money, they're going out and they're doing their vacations, or, maybe they might be splurging on, something in their patio, whatever it might be. Do you have any tips for people as they invest into the summer months? And as we know right now, gas prices, they are pretty expensive.
Yeah, Jeff, it's been said energy prices go up on the elevator and they take the stairs down. So I don't think you're going to see a dramatic decline in, the cost of gasoline and the cost of some of the airline tickets. I think if you're going to be taking trips this summer, you may be shocked at what the airline costs are. Fuel is the most significant cost that airlines deal with, and their fuel costs are up about 87% year to date. So most important thing, try not to take on any debt. Use your head. I don't think this is going to be over anytime soon by any stretch of the imagination, and I think we're probably going to be looking at more volatility as time goes on.
Tony Ogorek, thank you so much for joining us. We appreciate it. Good advice.